closed-end fund listed in Hong Kong, and it's very, very simple. Owns Chinese equities. It's small, illiquid, generally retail-owned, and it's been a fantastic trading position for GVF. And in fact, for any of you guys who have held GVF since the IPO, this was the first trade to go in the portfolio, and up until March this year, we've held it virtually continuously for that whole period. So you owe a lot to this investment. It's also one we were never allowed to talk about. We were sworn to secrecy over it. Miles would have kicked off if we ever mentioned this. So this is our one chance to talk about this. And just generally, we don't tend to talk about trading opportunities, but just because we want GVF to just continue to take advantage of them over time. So as I say, this was a very sort of simple fund. It owns Chinese equities, trading on a really, really big discount. And what made this particularly interesting is it had a policy whereby if the shares traded at a discount of 20% to asset backing for a period of 3 months or more, they would tender for the shares, tender for 20% of the shares at NTA. So this created a really interesting opportunity for us if you could buy it at wider than a 20% discount. Firstly, the policy there was going to stop the discount ever going too much wider than 20%. But also, if it remained wider than 20%, you had this opportunity to exit part of your investment every time that they tendered. And if you think about it, if it's trading on a 20% discount, you've got a 25% uplift to NTA. Over the 10 to 11 year period that we held this investment, they announced a tender 10 times. As shown here on the right, these are the solid blue diamonds here. Each time, on average, we exited 40% of our position at asset backing. And the reason for that is, as I mentioned before, this was retail owned. So most people are not going to open the letter. They're maybe not even going to bother putting in for the tender. The fact that we put all our shares in for tender, that means we can get out of 40% rather than the 20%. The hollow dot here is where in December last year, they announced that HSBC, the manager, had decided to terminate the fund and return investors' money back to them. We got our money back we got part of our money back in March this year. The rest of the money is coming back in August later this year once they repatriated the capital. Now, none of that means much if the fund underperforms as well. In fact, this fund has also delivered outperformance over the long term as well. You can see here on the bottom left a chart of the performance versus the MSCI China Index and China A shares. The fund's performance is in the blue. Over the long term, it had significant outperformance of both those indices. So we had two sources of alpha there, really. We had their outperformance plus the discount capture. If you combine both of those, our IRR over the course of this investment was 17.5%, which was well ahead of what we would have made had we been invested in those underlying markets. So it kind of goes to exactly what these trading opportunities are trying to achieve, which is to sort of bolt on some alpha from discount capture on top of an underlying market return.
Yeah, brilliant. Well done, Mark.